Hello everyone, welcome to a webinar by Alpha over Beta. My name is Alon and we are going to talk about interest rates and their effect on the markets. So what are we going to cover in this webinar? We're going to talk about the Federal Reserve. We're going to talk about the consequences of interest rate movements, which are actually set by the Federal Reserve. And we're going to talk about how those interest rate movements impact the stock market. So we're going to tie all those three topics together. Disclaimer first, Alpha over Beta is an investment service, an online service. We present data and charts and signals, but you should really use a customized risk solution for your own, and you should really consider the risk there is in investing in the stock markets or any other financial instruments that are presented in this webinar. So who am I? My name is Alon. I am the founder of Alpha over Beta. I've been trading the US stock market since 2005. I am giving lectures on trading the US stock market, and I have mentored many students on their way to become a successful trader. I lead the research and trading team, which are focused mostly on long-term portfolio investments with a view of low risk and high return. This is the main focus of the portfolio that I'm managing in Alpha over Beta. So let's start. The Federal Reserve Bank is really the central banking system of the United States. It was created in 1913, so quite an old establishment. It conducts the nation's monetary policy and really focuses on three aspects of the monetary policy. One, it looks at maximum employment. I think the Fed should be happy right now since the US job market really is in a very nice state. It is almost at full employment. The unemployment rate is as low as it has been for the past decade. So in that aspect, I think that the Federal Reserve had reached its target. The next factor that the Federal Reserve is looking at are stable prices. Volatility is not something the Federal Reserve wishes to see in the US economy. And then there's the third aspect, which we are going to focus today, and that's the moderate long-term interest rate of the US economy, which is set by the Federal Reserve Bank. Now, if you want to get to know the Federal Reserve a little bit better, I would recommend a book called The Creature from Jekyll Island. You can see the icon in the upper right corner. This book details the process of creating the Federal Reserve, what's the state of mind, and what is its expected output. I really recommend reading this short book, which has a lot of details about the Federal Reserve Bank. So let's discuss the basic term of interest rate. So let's start with a bank. A bank is an establishment that is there for lending money, and it's lending money to an investor. So the relationship between an investor and a bank is the investor actually receives a loan from the bank, which is an amount of money used by an investor for different purposes. Now, the investor, of course, once receiving the money, should actually give it back. So there's a two-way relationship between the investor and the bank. Now, the interest rate is exactly the difference between the amount taken by the investor and the amount that the investor returns. So the difference between those amounts is the interest rate. So let's say an interest rate is at 1%, and the investor lends $100. So if it's $100 that goes from the bank to the investor should return $101. Why? Because the interest rate stands on 1%, and 1% of $100 taken from the bank is $101. Using the same example, let's say that the interest rate is really high and reached 10%. This means that if the investor gets a loan of $100, the return amount is 110. Why? Because 10% of $100 is $110. So the difference is the interest rate. Now, the amount that is given to the investor actually goes right into the economy because the investor uses that money to create a business. And that means labor in that business, and materials in that business, and knowledge in that business, and that business affects other businesses. So basically you can look at an interest rate, or let's look at a loan as something that is actually good for the economy, since if you are taking a loan and using it to move the economy forward, that's a good thing. And if you know that you're going to return a low amount to the bank, you're highly motivated to take that loan. And if you know that the interest rate is super high and you have to return a large amount to the bank, then you're less motivated to take that amount of money and invest it back into the economy. So lower interest rates actually creates a movement, a positive movement in the economy. And a higher interest rate slows that a bit down. That's the relationship between the interest rate and the movement in the economy. So where do we stand as far as the US stock market? So continuing the example from before, if you are taking an amount to invest in a business and the interest rate is high, you know that you're less motivated to take that money and create new businesses. So large companies are less motivated and they have a less motivation of taking money, loans from the bank, and use it to increase their business. So investors look at a high interest rate as something that slows the business activity of a company, slows their revenue and their earnings, and consider to be a bit of a negative on the corporate operation. And on the contrary, if the interest rate is lower, then the corporate America is more motivated in taking loans from the bank for its own purposes to grow their business, hire more people, and buy more materials. So there actually is an inverse relationship between the interest rate and the markets as we see it, because if a higher interest rate holds the economy a bit trying to stop a bit the economy, then it affects the companies, and then companies do less business, hire less people, and the market sees that as less activity and the market moves down. So that's a bit of a inverse relationship between the interest rate and the value of the stock market. Now there is another aspect about interest rate that we should discuss, and that's the fact that if you are a large corporation and you have a lot of money, you seek to invest that money in the purpose of maybe grow that amount of money, or at least keep its value. And you do that by investing in the lowest, safest risks that you can find in the market. And bonds, US government bonds, are considered to be exactly that. They are an investment vehicle where you can buy a government bond and you know that the risk there is like super low, and the return on it is actually very much tied to the interest rate. So if the Federal Reserve raises interest rate, then the interest rate returned by US government bonds is higher. And then if you have a lot of money, we're talking billions and trillions, then you're more motivated to go towards bonds. Now, since all of your money, think about it like all of your money, 100% of your portfolio is invested in the market. So you're going to have to sell a bit of it that is invested in the stock market and buy with that bonds. Now, the selling operation of the stocks in the stock market creates some kind of pressure on the prices, and the prices move down. On the other hand, bonds move higher in that aspect. So the interest rate is tied to the US government bond. The higher the interest rate, the higher the motivation to buy bonds and sell the stocks. And of course, there's a ripple effect, and it goes to the dollar and oil, and we should discuss that maybe in another video that I'll have to do. On the ripple effect, the domino effect it has on the dollar and then on commodities. So here we're looking at the market for the past 10 years. As you can see, the upper chart describes the interest rate of the Federal Reserve as it was set in the last 10 years. As you can see, we were pretty flat, so starting 2009 until 2016. That was pretty flat. The reason it was flat is because 2008 there was a major financial crisis in the US economy, one that really was very significant, and it had a lot of bad effects on consumers and traders and the American people as a whole. So once the Federal Reserve saw that and saw the US economy just grinds to a halt, it lowered immediately the interest rate, and in the hope of moving the economy forward, as we spoke about it in the first half of the webinar. So as you can see, the interest rate was held pretty low, below 1% for a long time, and you can see that the market reacted very positively to it and was moving up higher and higher until 2016. And 2016 was really the first moment where the Federal Reserve decided that no more zero percent interest rate, easy money, no more easy money. And then the market took quite a shock at the beginning of 2016. You can see the drop in the stock prices, and it held for about 12 to 18 months, and then the market started to move back up again 2017. Now 2017, if you can see, was a bit of an anomaly, because 2017 the market moved up and the interest rate moved up. And the reason for that is that the notion was that the interest rate below 1% is not high enough. It shouldn't stop any corporate from doing more and more business, hiring more and more people. So below 1% was considered low. Once we crossed the 1.5%, we were in the high category. So you can see that 2018, as the interest rate continues to move higher, 2018 actually was quite of a drop in the US stock market, and at the mid 2018 we saw quite a crash of 20%. And you can see that the volatility started to shift higher starting 2018. And now, the last thing that happened this week was that the Federal Reserve actually, for the first time in many years, lowered its interest rate. Now, this was a bit of a preventive interest rate cut, because the Federal Reserve is looking at other factors that we haven't spoken about, like the global economy, which seems to be slowing a bit down, and inflation, which is also some sort of an influencer on the Federal Reserve. They want to see inflation at around 2%, and we're not there. So in the hope of giving a little nudge to the economy, maybe it can reach the 2% target in inflation. This was a preventive interest rate cut. And of course, politics has to be there also. President Trump is bashing pretty badly at Jerome Powell, who is the head of the Federal Reserve, bashing him again and again to lower the interest rate in the favor of lower and lower interest rates. So I don't think that the politics completely rules the decision making of the Federal Reserve, but it's definitely there. So tying it to Alpha over Beta, which is the online service that we're providing, we actually have an investment strategy that balances the two in the most delicate way. We have a strategy called pairs trading that actually looks at a portfolio and invests in bonds when the interest rate goes higher, and invest in stocks when the interest rate goes lower. So how do you do that? Let's go over to our web page to see that. So here you have your strategies. You can click the strategies and you can go to the strategies page. Now you can actually see all the strategies that we have on the web page, and down below we have this intelligent pairs trading. This is the one that I was talking about. Once click there, you can see all the description and the details about it, and you can actually see its performance in the last 10 years. It actually beat the market. The blue line here is the performance of the portfolio, and the red one is the market. So we know how to balance the two in favor of better performance. So I hope you enjoyed this webinar. I hope it was informative, and I would like to thank you for your time. If you have any question regarding this issue or any other issue that is tied to the market, please shoot me an email at alon@alphaoverbeta.net. And until next time, have yourselves a great week of trading.